Marc Faber, welcome to The Business.
Well, thank you for having me on your program.
Mark, Warren Buffett once said of contrarian investors, they are to be fearful when others are greedy and greedy when others are fearful. What are you right now, greedy or fearful, and why?
Well, I think that it may be a time where it's not appropriate to be particularly greedy. I think we need to see that because of monetary policies that the central banks around the world have followed, with artificially low interest rates and money printing, and this started already in the late 1980s, 1990s, they've managed to kind of postpone problems instead of solving them for a very long time, and to eliminate some risks in the markets that should have occurred earlier. And so we have now a situation where the central banks are in a very difficult position, because if they don't increase interest rates, inflation will likely accelerate. And if they increase interest rates at the time, GDP in the first quarter in the US was down, and the mortgage applications and so forth, the many economic indicators that are down, world trade is down, the geopolitical situation, and you know this very well from Australia, regarding the Solomon Islands, is not favorable. We have, in essence, a trade war. And so many things are not conducive to high equity valuations.
Okay.
Now, if you look at the whole equity market, of course, there are stocks that, like the FANG stocks in America, the index is now down more than 30% from the November highs. But there are other stocks that are very inexpensive. Like if you look at Hong Kong shares are selling at half book value.
It's an extremely critical week for central banks. Some have already started raising rates. Many more are poised to move. What do you think the US will increase by this week, and how far will the Fed keep going?
It's a very good question, because I don't think they can increase interest rates very much. Otherwise, the system collapses. Ditto in Japan. In Japan, you have an even worse situation. But I can tell you, say we have in America an economist, John Taylor is a professor in Stanford, and he established a rule where, say, short-term rates should be in order to maintain a stable economic financial system. According to that rule, the Fed fund should be at 9.81%. The whole world is bankrupt if the Fed fund rate goes to 9%. So I think the Fed will increase rates by 0.5%, and then maybe another 0.5%. You see, the problem now is this. In the recession of 2001, 2003, the bear market, in the great financial crisis, 2000, 2008, until March 2009, during those bear markets, and also in the COVID crisis, February, March 2020, during these stock bear markets, interest rates went down and bonds rallied. So investors offset some of their stock losses with bond rallies. Now the bond market is down, the long-term bond market is down more than 30% in the US from the peak in 2021. And therefore, people have actually large losses on stocks. Plus, the young people all invested in meme stocks, SPACs. It's, of course, the most speculative sector. These stocks are down like 60%, 80%. The ARK Innovation Fund, which was the kind of the most popular investment fund among aggressive investors, is down 68% from the high.
So is there any danger that there'll be overreach from the Fed and rates might move too high and stifle growth?
Well, I think because I started to work in 1970, so you can imagine how old I am. But in the 70s, nobody expected inflation to accelerate as much as it did. And when I started to work in 1970, the 10-year treasury in the US was at 6%. It then went to over 15%. You understand? These moves, both inflation and interest rates, can go much further than is expected. Nobody in the whole world expected ever to have negative interest rates in the world. We had that never in history before, in the 5,000 years of recorded history, were interest rates this low as they were in 2020, 2021. That is a huge manipulation by central banks. And now the market has called them bluff, and they are in a difficult position. But they're in a difficult position because of their mistakes.
Do you expect there to be a contagion effect when the US starts to raise rates? Do you think it'll force other central banks around the world to do the same?
Well, in Japan, they don't want, because they know the country's bankrupt. You say the JGB rate, the government bond rate, goes to 2%. So they keep it at 0.25%. But in economics, when you intervene, there is something that will break. So the yen broke. The yen has been very weak. And in Europe, Lagarde, who is the president of the ECB, all these people are criminals, in my opinion, because they destroy the purchasing power of ordinary people with low salaries and high taxes. They suffer the most, and the rich people, they can hedge, they can change their money in other currencies and so forth and so on. This opportunity is not given to the lower and the middle class. And therefore, I have a very, very low opinion of central bankers around the world. They don't know much about economics at all, because they haven't worked or read the classical economists. They all deal with abstruse theories that they invented in the last 10 years to justify their interventions into the free market.
So, Marc, do you think, given we're about to see central bank rate rises, this will mark the end of quantitative easing for good around the world?
Well, I think that it would be best for the world to probably take a recession now and try to clean up the system somehow. Whether they can clean it up entirely, that I doubt. But if they continue, say, if the Fed increases the Fed fund rate to 1.5%, and then they realize the economy, I think the economy is already in a recession globally, because when world trade contracts and when disposable income in real terms collapse, in real terms means adjusted for inflation, then you're in recession. And when the governments and the central banks will realize that they are in recession, and the stock market and the bond market crash has already had a huge wealth impact on most people and on pension funds. Now the pension funds are in trouble. So they will ease again, in my opinion. When they started QE1, that was, the announcement was in December 2008. They asked me on TV, when do you think they will take this back? I said, once you embark on QE1, it's a continuous process and it will be QE infinity.
If I can move on to tech stocks now, you mentioned those earlier. They're taking a hit. The Nasdaq's down 25% in 6 months. Do you expect this trend to continue? And do you think they're leading the way for other indexes?
Well, tech stocks, we have to define which ones. You know, some tech stocks are down 80, 90%, and the market is now oversold, so they could rally somewhat. But the FANG stocks, Facebook, Amazon, Netflix, Google, and Microsoft and so forth, and Tesla, some of these stocks are not cheap yet. They may be down 50% or so, but they're not yet cheap.
So, Mark, do you think that we're heading for a global stock market correction or a crash?
Well, I think we are in a bear market, period. If you look at stocks, in Europe, they're all down. In Asia, most stock markets are down from 2015. And if you adjust it, especially for the US dollar, because you have to kind of decide in what currency do I want to value my stocks. So you can value it everything in US dollars. In that case, most markets around the world have been in bear markets. But this is the beauty of markets. Not many people understand the market because the market can hide. When you have, say, 1,000 stocks in a stock market and 5 go up, then these 5 stocks can drive the index up and everybody thinks, oh, the market is strong. And 995 stocks are down. This is what has happened in the US. The handful of stocks that drove the market to a new high for the NASDAQ November 22nd, and for the S&P peaked out on January 4th of this year. But
So,
the rest of the market was down a lot already.
Mark, you wrote in one of your recent reports that we may be at the beginning of a slope of hope gradual decline in asset prices that will decimate the most popular sectors. How do you think this will play out?
Well, I think that, Australia is a resource-rich country, and I would expect commodities to decline less than, say, financial assets. Let's say if I look at gold, gold is a resource, is a precious metal. It's a monetary asset, but it's also an industrial commodity to some extent. But gold shares are a financial asset. So in this market rout recently, when the stock market went down, gold shares actually also went down a lot because they're a financial asset. People say, oh, I diversify, I buy Bitcoins. Well, Bitcoins correlates very closely with the NASDAQ 100. The NASDAQ 100 peaked on November 22nd, 2021, last year. Bitcoin on November 26th. Since then, the NASDAQ is down more than 20%, and Bitcoins is down almost 40%.
So what's in your portfolio now, and how should investors approach the next year? Where do you think the value can be found?
I buy value stocks. I'm not in technology. I have essentially 4 sectors in my portfolio. One is real estate. And then I have cash and short-term bonds for the yield. And I have equities. And I have precious metals. And they are diversified. So as an individual, I think if you look at what has happened, that the US can go and expropriate Russian oligarchs, then I say to myself, oh, one day they may come and say, oh, we expropriate the Swiss. Another day they can go and say we expropriate the Australians, and so forth and so on. I think this is a very negative development, and also like the freezing of the foreign exchange reserves of Afghanistan. Afghanistan, if you look at videos, is a dirt poor country, and you're stealing $4 billion from them. The little they have is a complete disastrous policy. It's vicious. And then you look at the reserves of Russia. They've frozen these reserves. The Chinese say, oh, okay. They freeze the reserves of Russia. we better do something about our reserves. The war in Ukraine has split the world in two parts. What they call everybody is 12% of the population in the world. America, Western Europe, the vassals in Europe, Australia and Canadian, all vassals of the US. And the rest of the world is 88%, includes India, China, Indonesia, Brazil, all these countries. They think now twice about having their reserves in US dollar. I think the Ukraine war will be very costly for the Western world. It's a suicide for Europe, a suicide.
And finally, Marc, should the main aim of investors now be preservation of capital?
I agree with you 100%. For the last 20 years or so, the idea was always to maximize your profits, you understand, to outperform someone. In Australia, I follow all the fund managers. All what there was talk how this one is performing, that one is performing. How have they performed lately? Very badly. And I think as an investor in the current situation, you should say to yourself, whatever I have, I want to invest in such a way that if Marc is right and we have this implosion in asset prices from real estate to stocks to bonds to everything, if Marc is right, I want to be among them who loses the least. So if the market, say, is down on average by 50%, I want to be down by just 10, 20%. This is the strategy, in my view, that this is the strategy that I follow. We will all lose money if things turn out the way I think.
Marc Faber, thank you.
You're welcome. Thank you very much for having me on your program.